micro 20 MA halt plays. This is how you use this to make money in the markets daily. With this, with variation number 2, I'm going to elevate your ability to read bottoms appropriately. I'm going to teach you specifically where to strike, how to protect yourself, and how to position yourself to not only make money on a daily basis with this tactic, but also grab big life-changing gains on bigger time frames with the same tactic. So let's go. This variation brings us to what I'm going to call, this tactic is called the 20 MA halt buy. So we need a 20 period simple moving average of the trading item, whatever time frame this is. This is the trading item. We want an item that has spent a decent period of time under its 20 period moving average. So during this period of time, your stock or your tradable item is under a declining 20 period moving average. I'm going to repeat that. Your item needs to spend a decent period of time under a declining 20 period moving average. Notice that's criteria 1. Criteria 2, after spending a decent amount of time under the 20, for the first time, we need a move that breaks through the 20 convincingly. Not a peekaboo break, but a convincing break. This is a peekaboo break. Let me show you what a peekaboo break is. Stock drops. That's a peekaboo break. I'm not talking about a peekaboo break. I'm talking about a break that actually finds itself lifting decently above the 20. So we don't have to be super far, but it separates itself above the 20. Okay? That's criteria 2. So criteria 1, we need the stock spending time under a declining 20. Criteria 2, we need the first crack through the 20, and we need to get elevated decently above the 20. Now, criteria 3 is we need to see the stock retest, drop back, and halt at the 20. We want to see a halt at the 20. We want to see that 20 period moving average catch it. All right? We want to see, guys, look at me. We want to see that stock fall back and boom, the 20 period moving average catches and says halt. Who goes there and pushes it back to the upside? All right? So that first time we crack through the 20 period moving average, right? And then we catch that next pullback, and the 20 lifts it back to the upside. Do you follow what I'm saying? That's what we're looking for. Here, at this point, I want to see, guys, I want to see something powerful. I want to see something strong. Do you understand? I want to see that right there. I want to see green. I want to see power. I want to see violence. I want to see oomph. Do you understand? I want to see something unmistakable. All right? I want to see, guys, I want to see boom. All right? I don't want to see boom, boom. All right? I want to see boom. I want to see something powerful. I want to see something violent. I want to see something unmistakable. Boom, boom, boom. You know what I'm saying? That point there at that 20 period moving average is key, but the catch is not enough. It's not enough to catch. That's not enough. I need the catch and the boom. The catch and the boom. Okay? You follow what I'm saying, right? I need something boom right there. And I'm going to dive into the boom. Boom. I'm going to put my money into the boom. Okay? Now, cover more of this when we go to some specific examples. Now, here's what's cool. All right, I'm going to show you what's really cool, guys. This is the time frame. We're looking at a 2-minute chart. What this means is that every bar represents 2 minutes of trading. Now, if you followed my work for any period of time, you know that we focus on the 2-minute chart to make daily money. We focus on the daily and weekly chart to make macro money, wealth money, but we focus on the 2-minute chart predominantly, sometimes the 5-minute chart, but predominantly the 2-minute chart to make money. Now, remember that I told you what we need is the trading item, and we need, that's a 2-minute chart of the trading item, and we need a simple 20-period moving average. That's that blue line, simple 20-period moving average. What this moving average does is just average the last 20 closing prices of the last 20 2-minute bars. It smooths out the data. Now, criteria 1, we need the stock spending a decent amount of time under a declining 20-period moving average. That's criteria number 1. All right, I like to draw multiple times. This helps you retain the information. Stock spends a decent period of time under a declining 20-period moving average. Criteria 1. Criteria 2. All right, we'll talk about this in a minute. But criteria 2, I need the stock from under the 20 to get above the 20. I need it to be, in most cases, I'd like to have it, have some space between the item and the 20-period moving average. So not a peekaboo blip above. See, this is peekaboo. Boing. I need non-peekaboo, okay? And we need the next pullback to halt, boom, at or near. Now, let me give you some details about why I say at or near. Every moving average is not a skinny line as the chart would have you believe. The chart is a liar when you're looking at moving averages. In reality, your moving average is more like a zone or more like a fence that you can lean on. Never look at it as if it's a skinny, tiny line. It's a zone. It's like a rubber band. Now, look at me carefully. Look at me carefully. It's like moving averages are like fences that you can lean on. The stock can move and bend the moving average, and the moving average snaps the stock back. It can bend this way and snap the stock back. But on the chart, the moving average can't bend. So you see it as a mild break. But the mild break is not a break. It's leaning on like a boxer leaning on the ropes and comes back. So remember that a little tiny break on the chart is more of a lean, not a break. Remember that. A mild break of a moving average on a chart is more of a lean. So check this out, guys. We get above the 20. This is not a break, that's a lean. But look at the power. Look at the violence. Look at the oomph. Look at that surge. We dive into the green off the 20 MA halt. You put your money into the first power green. I'm going to repeat that, traders. You put your money into the first power green. You can wait toward the end of the power green. That's a 2-minute power green bar. You can wait for a minute 45 seconds, a minute 50 seconds. Just don't let that 2-minute finish without putting your money inside of that bar. Your money is inside of the first power green. I'm going to repeat that again. Your money is inside of the first power green off of the 20 MA halt. We are going to be 20 MA halt experts. Put your money inside of the first power green off the 20 MA halt. Now, once your money is in the bar, your protection is under the bar's low. Simple. money in the bar, protective stop, 1 penny under the bar. Don't lose the bar. Listen, traders, this is one of my number one trading precepts. Don't ever, well, don't generally lose more than 1 bar. Think about this. You go inside of a bar, your protection's underneath the bar. You got that? You go inside the bar, protection's underneath the bar. You buy the bar, protection's underneath. You buy the bar, protection's underneath. You buy the bar, protection's underneath. And check this out. If you lose on the vast majority of your trades, you lose just 1 bar. Guess what your winners are going to do? You're going to win 5 bars, but lose 1 bar. You're going to win 10 bars, but lose 1. You're going to win 3 bars, but lose 1. You're going to win 40 bars, but lose 1. Every loss is going to be 1 bar, but your wins will be 40 bars, 20 bars, 10 bars, 2 bars, 4 bars, 19 bars, 11 bars, 6 bars, 7 bars, 80 bars. But you'll always limit your loss to 1 bar. This is what's going to keep you in this business forever. This is going to prevent you from being a chronic loser. This is going to keep you out of trouble. This is going to prevent you from blowing up your account. This concept, 1 bar losses. You got that? You got it. All right, good. Let's go. Let's keep going. This is amazing. So we're putting our money into the bar off the 20. We're putting our protective stop look at what our risk is. Right after 10 o'clock Eastern time, New York time, boom! And look at your potential gain. Now, guys, I'm always telling my traders, you have to be a snowman trader. Your loss is the head of the snowman. Now, look, here's a snowman. I don't know, for those of you who, I grew up in New York. We used to have snowstorms, and I used to love snowstorms because I'd go out and build my, this is an upside down snowman. But you want fat profits. Do you understand? That's his little feet. But you want fat profits. See how fat that snowman is? You want fat profits, but you want little losses. There's my loss. Now, how many heads of this snowman fit inside of that body? A lot. That's proper trading. That's proper risk management. The snowman approach to trading, that's keeping your losses significantly smaller than your potential gains. That's what's going to keep you in this business. That's what's going to prevent you from blowing up. That's what's going to send you to that very desirable state we call mastery in trading. This is one of the number 1 rules you can apply, guys. Never lose more than 1 bar. That's the 20 MA halt, guys. Remember the criteria because I'm going to speed through this time. All right. Stock spends a decent amount of time under a declining 20. Stock from under the 20 gets height above the 20. Criteria 2. The pullback halts at the 20 and gives you a power green bar, which you buy before the power green bar finishes. 15 seconds, 20 seconds before the 2 minutes is finished. Boom! You're in the bar. Your money is inside that bar. Your protection is right under that bar's low. And that's that wonderful sound that I want you to get very used to. All right? That's that wonderful sound. You got it? We're going to get used. I want you to get used to get used to that sound. I know I'm crazy, guys, but I know, listen, some of you have that sound. Some of you have it like this. But we want it to be like this. All right, we're going to get there. We're going to get there. I promise. And so here's our declining 20-period moving average. Here's the stock having spent a great deal of time under the 20. That's criteria 1. Stock, you see how here the stock doesn't get real height. You see, that's problematic. You really want height. See the height? That's preferable. The height is preferable where you have some space between the stock or the item and the 20. Now we pull back. Get ready, get ready, get ready. Boom! Look at the power green. Look at the surge. Look at the violence. You're going in this bar. Now, I want to give you something a little extra here. If your power green bar eliminates a nice, sizable, fat red bar, you don't have to, you can go in right there. So here's a little bar. Some of my traders would get in right above the red right there. Boom. And that's cool too because their stop is so close. But it's the fat one that you really want a decent size red to be taken out. So boom, that's your key. Some of my traders would buy there. Some of my traders would buy there. It's the significant bar removal that's really the key. Here, we're under a declining 20-period moving average. All right. This doesn't really get enough height, but this does. We pull back. There's the halt. Boom! Now, when can I really enter this? When, see that red bar right there? When that red bar gets taken out, boom! Money goes in here. Protection goes right under. This is your risk. Uh-oh, here's that snowman again. Boom! Now, guys, I'm not talking too much about profit taking today. That's a different topic, but you all should know, if you follow my work, that I teach my traders to take profits when you get distances away from the 20. When you get distances away from the 20, you're due for a setback, right? The same way when you get distances away to the downside, you're poised for a snapback. All right? So it's distance away, distance away, distance away. All right?